You were taught global debt reached $315 trillion because governments spent beyond their means. Politicians made promises. Voters demanded programs. The money ran out. This story is a cover. The real cause sits in a single decision made in August 1971 at Camp David. President Richard Nixon gathered his advisors for a secret weekend meeting. By Sunday evening, they had dismantled the global monetary system built at Bretton Woods in 1944. They called the change temporary. 53 years later, the temporary fix remains permanent. Nixon did not remove a technicality. He removed the structural constraint on debt creation. Before 1971, every dollar in circulation connected to gold held in Fort Knox. Foreign governments held $35 and demanded 1 ounce of gold in exchange. This linkage created pressure points. It forced discipline. It limited how much the United States and its allies borrowed. After August 15, 1971, those limits vanished. The new system created infrastructure for extraction on a scale ancient emperors never achieved. It built bottlenecks where central bankers became gatekeepers of credit flow. It engineered incentives where debt grew faster than the economy paying for it. The architects understood the machinery they built. They chose concentration of financial leverage over stable money because the immediate crisis demanded a solution, and the long-term consequences would fall on someone else. The global debt load in 1971 stood at roughly $5 trillion. Today, it stands at $315 trillion, a 6,200% increase in 53 years. Welcome to Noob Historian. We follow the money, trace the power, and expose the history they never taught you in school. This is not ancient history stored in archives. Every dollar sitting in your savings account loses value because of decisions made before you were born. Every mortgage payment you send to the bank feeds a debt machine built in the 1970s. Every paycheck deduction for taxes, services, interest on obligations accumulated by previous generations. The $315 trillion represents a claim on your labor, your time, your future. You did not sign for this debt. You inherited it. And the 5 decisions documented in IMF records, central bank archives, and G20 summit proceedings show exactly who built this system, when they built it, and why they chose to leave you holding the bill. The story begins at a mountain resort in New Hampshire in 1944, ends in a fractured global economy in 2024, and explains why your purchasing power shrinks while debt numbers grow beyond human comprehension. 5 decisions, 53 years. $315 trillion. Here is how they did it. In July 1944, delegates from 44 nations gathered at the Mount Washington Hotel in Bretton Woods, New Hampshire. World War II still raged across Europe and the Pacific. The delegates came to design a monetary system for the peace. The architect was Harry Dexter White, a senior Treasury Department official. White designed a system with the United States dollar at its center. The dollar would anchor to gold at $35 per ounce. All other currencies would anchor to the dollar. This created a pyramid of monetary stability. The system worked because it contained a discipline mechanism. Any foreign government holding dollars possessed the right to exchange those dollars for physical gold at the Federal Reserve. France, under Charles de Gaulle, exercised this right aggressively throughout the 1960s. French ships arrived in New York Harbor. French officials walked into the Federal Reserve Bank of New York. They exchanged paper dollars for gold bars. They loaded the gold onto the ships. They sailed home. This system created what economists call an external constraint. The United States could print dollars, but foreign governments could drain gold reserves in response. The constraint forced fiscal discipline. It limited how much the government borrowed. It punished excessive money creation through gold outflows. By the late 1960s, the constraint began to bite. President Lyndon Johnson escalated the Vietnam War while expanding domestic spending through the Great Society programs. The federal budget deficit grew. The Federal Reserve printed dollars to finance the gap. Foreign governments noticed. They accelerated gold redemptions. Between 1958 and 1971, United States gold reserves fell from 20,000 metric tons to 9,000 metric tons. The Treasury watched half the gold supply leave the country. At the redemption rate of $35 per ounce, the math turned dangerous. More dollars existed overseas than gold existed in American vaults. The system built at Bretton Woods faced a simple arithmetic problem. Too many claims chased too few ounces. Nixon inherited this crisis in 1969. His Treasury Secretary, John Connally, a Texas Democrat turned Republican ally, proposed a radical solution. Break the link. Suspend gold convertibility. Let the dollar float against other currencies. Nixon resisted initially. Breaking the gold link meant breaking America's word to its trading partners. It meant defaulting on an explicit promise. The Bretton Woods Agreement stated clearly, $35 equals 1 ounce of gold. Suspension meant telling the world those words no longer applied. By August 1971, Nixon had no viable alternative. The British ambassador had requested a gold redemption of $3 billion. Other nations lined up behind Britain. If Nixon honored the requests, the gold vault would empty. On Friday, August 13, 1971, Nixon summoned his top economic advisors to Camp David. The meeting included Connally, Federal Reserve Chairman Arthur Burns, and future Secretary of State George Shultz. For 2 days, they designed a new monetary order. On Sunday evening, August 15th, Nixon addressed the nation. He announced the suspension of dollar-gold convertibility. He framed the action as temporary. He framed it as an attack on speculators. He framed it as defense of the American worker. The framing was political. The substance was financial revolution. Treasury Secretary Connally later explained the philosophy to foreign finance ministers with brutal clarity. "The dollar is our currency," Connally declared, "but it is your problem." This single sentence captures the structural shift. Before August 1971, American monetary excess created an American problem through gold outflows. After August 1971, American monetary excess created a foreign problem. Other nations held dollars they could no longer redeem. They had two choices: accept the dollars and absorb American inflation, or reject the dollars and watch their export industries collapse as their currencies rose against the dollar. Most chose to accept the dollars. The external constraint on American borrowing evaporated overnight. The golden handcuffs came off. The discipline mechanism disappeared. Global debt in 1971, approximately $5 trillion. The machinery of expansion was now operational. The decade after Nixon's announcement delivered exactly what skeptics predicted. Inflation surged. The dollar fell against gold from $35 to over $800 by 1980. Oil-producing nations, paid in depreciating dollars, responded with price shocks in 1973 and 1979. The Consumer Price Index in the United States rose at double-digit rates. The Federal Reserve faced a credibility crisis. Without gold backing, the dollar's value depended entirely on trust. Trust depended on inflation control. Inflation control depended on interest rate policy. And interest rate policy required accepting economic pain. In August 1979, President Jimmy Carter appointed Paul Volcker as Federal Reserve Chairman. Volcker stood 6 feet 7 inches tall. His reputation matched his physical presence. He arrived with a mandate to crush inflation regardless of economic consequences. Volcker raised the federal funds rate to 20% by June 1981. No central banker in American history had attempted such aggressive tightening. The policy worked on inflation. Consumer price increases fell from 13.5% in 1981 to 3.2% by 1983. The policy also triggered global consequences the Federal Reserve did not anticipate or did not prioritize. Throughout the 1970s, American and European banks had recycled petrodollars. Oil exporters deposited their profits in Western banks. Western banks loaned those deposits to developing nations at floating interest rates tied to American benchmarks. Latin American governments borrowed aggressively. Mexico, Brazil, Argentina, and Venezuela accumulated external debts in the tens of billions. When Volcker raised American rates to 20%, those floating rate loans repriced overnight. Mexico had borrowed assuming interest costs around 6%. Suddenly, Mexico owed interest at 18%. The math broke. Export revenues could not cover debt service. On August 12, 1982, Mexican Finance Minister Jesus Silva Herzog informed the United States Treasury and the IMF that Mexico could not meet its obligations. The announcement triggered panic across Latin America. Brazil, Argentina, Venezuela, Chile, Peru, and others faced identical mathematics. Banks that had recycled petrodollars now faced massive losses. Citibank, Bank of America, Chase Manhattan, and other major American institutions had exposure exceeding their total capital. A wave of defaults threatened to collapse the American banking system. The crisis demanded a policy response. The response established a template that persists to this day. The United States Treasury, working with the Federal Reserve and the IMF, organized emergency lending. The emergency loans carried conditions. Debtor nations accepted structural adjustment programs requiring privatization of state enterprises, reduction of government spending, and opening of domestic markets to foreign goods and capital. The banks received protection. The citizens of debtor nations received austerity. The structural adjustment programs of the 1980s created political instability, economic hardship, and lasting resentment across Latin America. The crisis also produced a second policy decision with lasting consequences. In 1989, Treasury Secretary Nicholas Brady proposed a new approach. Banks would accept partial write-downs on their Latin American loans. In exchange, debtor nations would issue new bonds backed by United States Treasury securities as collateral. These Brady bonds converted bilateral bank debt into tradable securities. The innovation seemed technical. Its implications proved structural. Before Brady bonds, sovereign debt consisted of bank loans. Banks held relationships with debtor governments. Restructuring meant bankers and finance ministers negotiating in closed rooms. The lender knew the borrower. The borrower knew the lender. After Brady bonds, sovereign debt became securities traded on global markets. Thousands of investors owned pieces of government obligations. Restructuring meant coordinating anonymous bondholders across jurisdictions. The machinery of sovereign lending transformed into the machinery of sovereign securities markets. This transformation created the infrastructure for the next phase of debt expansion. Governments now borrowed by issuing bonds into global markets. Markets demanded constant issuance. Issuance created debt accumulation. Accumulation proceeded without the friction of banker relationships or lending limits. Global debt. By 1989, approximately $20 trillion. The Bank for International Settlements documented the pattern in quarterly reports throughout the decade. Debt grew faster than the economy servicing it. The warning appeared in official publications. Policymakers read the publications. They continued borrowing anyway. The 1990s brought a new phase in the debt architecture. Previous decades expanded government borrowing. The 1990s expanded private borrowing through financial instruments the regulatory framework barely understood. The process began with deregulation. In 1999, President Bill Clinton signed the Gramm-Leach-Bliley Act, repealing core provisions of the Glass-Steagall Act of 1933. Glass-Steagall had separated commercial banking from investment banking. Commercial banks took deposits and made loans. Investment banks underwrote securities and traded for their own accounts. The separation prevented deposit-taking institutions from gambling with customer funds. Gramm-Leach-Bliley removed the wall. Commercial banks, investment banks, and insurance companies merged into financial conglomerates. Citigroup, formed from the merger of Citicorp and Travelers Group, exemplified the new model. A single institution now took deposits, traded derivatives, underwrote securities, and sold insurance. The consolidation created concentration. By 2007, the 6 largest American financial institutions held assets equal to 60% of United States GDP. These institutions became gatekeepers of credit flow. They controlled the bottlenecks through which money moved. Their survival became synonymous with systemic stability. The concentration enabled a second transformation, the rise of shadow banking. Traditional banking operated on balance sheets regulated by government agencies. Shadow banking operated through structures designed to escape regulation, structured investment vehicles, collateralized debt obligations, credit default swaps, and repurchase agreements created a parallel financial system with leverage exceeding anything permitted for regulated banks. The machinery worked as follows. A mortgage lender originated a home loan. The lender sold the loan to an investment bank. The investment bank bundled thousands of loans into a mortgage-backed security. The security received a credit rating from Moody's or Standard & Poor's. Pension funds, insurance companies, and foreign governments purchased the rated securities. The investment bank used the proceeds to buy more loans. The cycle repeated. Each rotation increased total debt. The homeowner owed the mortgage. The investment bank owed the entities funding its operations. The pension fund relied on the security payments. Credit default swaps created additional obligations between parties betting on whether borrowers would repay. By 2007, the shadow banking system held assets exceeding traditional banking. The Federal Reserve estimated shadow bank liabilities at $16 trillion. Traditional bank deposits totaled $10 trillion. The unregulated system had outgrown the regulated system. This growth proceeded with limited oversight. The instruments were new. The regulatory agencies lacked authority over many participants. The profits were enormous. The political system had no incentive to intervene. Alan Greenspan, Federal Reserve Chairman from 1987 to 2006, championed the transformation. Greenspan argued that derivatives spread risk across the financial system. He opposed regulation of credit default swaps. He celebrated financial innovation. His published speeches and congressional testimonies document this philosophy. The philosophy rested on an assumption. Sophisticated financial institutions would manage their own risk, market discipline would prevent excess, government intervention was unnecessary. The assumption collapsed in 2007. Mortgage defaults in the subprime sector triggered cascading failures across the shadow banking system. Securities backed by mortgages lost value. Institutions holding those securities faced margin calls. Credit default swaps required payments their issuers could not make. The machinery designed to spread risk concentrated losses in ways no model had predicted. By September 2008, the crisis reached existential intensity. Lehman Brothers filed for bankruptcy on September 15th. The money market funds that held Lehman commercial paper faced runs. Insurance giant AIG required $182 billion in government support to honor credit default swap obligations. The global financial system approached total collapse. Global debt by 2007, approximately $140 trillion. The BIS had documented the accumulation in quarterly reports throughout the expansion. Their economists warned about credit cycles and financial fragility. The warnings appeared in working papers and annual reports. Policymakers had access to the data. They chose to ignore it because the immediate politics favored growth over caution. The crisis demanded a response. The response would double global debt in less than 15 years. The financial crisis of 2008 forced central banks into unprecedented territory. Traditional monetary policy worked by adjusting short-term interest rates. The Federal Reserve lowered rates to stimulate borrowing and spending. When the economy overheated, the Federal Reserve raised rates to slow activity. By December 2008, the Federal Reserve had lowered the federal funds rate to zero. Traditional policy had reached its limit. The economy continued collapsing. Unemployment rose. Credit markets remained frozen. The machinery of rate adjustment could do nothing more. Federal Reserve Chairman Ben Bernanke proposed a different approach. The Federal Reserve would create money electronically and use it to purchase financial assets. Treasury bonds, mortgage-backed securities, and other instruments would move from private balance sheets onto the Federal Reserve's balance sheet. This process received the technical name quantitative easing. The first round began in November 2008. The Federal Reserve purchased $600 billion in mortgage-backed securities and $100 billion in agency debt. A second round followed in 2010. A third round in 2012 introduced open-ended purchases of $85 billion monthly. The Federal Reserve balance sheet grew from $870 billion in August 2007 to $4.5 trillion by 2015. Other central banks followed. The European Central Bank launched its own quantitative easing program in 2015. The Bank of Japan had pioneered the approach in 2001 and expanded it throughout the 2010s. The Bank of England participated. By 2019, major central bank balance sheets held combined assets exceeding $15 trillion. The programs produced intended effects and unintended consequences. The intended effect was financial stabilization. Asset purchases supported securities prices. Supported prices prevented further banking failures. Credit markets unfroze. The immediate crisis passed. The unintended consequences reshaped the global economy. Quantitative easing pushed interest rates across all maturities toward zero or negative territory. In Europe and Japan, government bond yields turned negative. Investors paid governments for the privilege of lending to them. Zero and negative rates created desperate search for yield. Pension funds required returns to meet obligations to retirees. Insurance companies needed investment income to pay claims. Endowments and sovereign wealth funds managed assets for long-term beneficiaries. All faced the same problem. Safe assets produced no income. The search for yield drove capital into riskier investments. Corporate bonds, emerging market debt, real estate, and private equity received inflows disconnected from fundamental values. Borrowers found willing lenders at terms previous generations would have considered absurd. Corporations responded rationally to the incentive structure. Debt became nearly free. Companies borrowed to buy back their own stock, boosting earnings per share and executive compensation. They borrowed to fund acquisitions. They borrowed to pay dividends. American non-financial corporate debt rose from $6 trillion in 2007 to $11 trillion by 2019. Governments responded similarly. Deficit spending carried minimal interest costs. Political incentives favored spending over austerity. Global government debt rose from $30 trillion in 2007 to $70 trillion by 2019. The accumulation proceeded without the constraints previous monetary systems imposed. No gold redemption limit existed. No exchange rate mechanism punished excessive issuance. The only constraint was inflation, and inflation remained subdued throughout the decade. Central bankers claimed victory. They had solved the crisis without inflation. The claim ignored alternative explanations. Globalization suppressed goods prices through cheap labor in China and elsewhere. Technology reduced costs in communications and computation. Aging demographics reduced consumption pressure in developed economies. The absence of consumer price inflation reflected these structural forces, not central bank success. Asset price inflation told a different story. House prices, stock prices, and bond prices rose throughout the quantitative easing era. The inflation appeared in asset markets rather than consumer markets. Wealth concentrated among asset owners. Workers without assets fell further behind. The Federal Reserve FRED database documents these patterns in granular detail. The numbers sit in public databases. The trajectory is clear. Debt accumulated faster than income. Asset prices rose faster than productivity. The gap between financial values and economic fundamentals widened with each passing year. Then came March 2020. The COVID-19 pandemic triggered the fastest economic collapse in recorded history. Global GDP fell 3.5% in a single year. Unemployment in the United States reached 14.7% in April 2020. Credit markets froze for the second time in 12 years. Central banks responded with quantitative easing at a scale dwarfing 2008. The Federal Reserve balance sheet rose from $4.2 trillion in February 2020 to $8.9 trillion by April 2022. The expansion of $4.7 trillion in 2 years exceeded the total expansion of the previous decade. The European Central Bank, Bank of Japan, and Bank of England expanded proportionally. Governments borrowed to fund pandemic response programs. The United States passed $5 trillion in fiscal stimulus across multiple bills. European governments suspended budget rules. Developing nations borrowed from international institutions. Global government debt rose $30 trillion in 2 years. Global debt by 2022, approximately $300 trillion. The fifth decision of the debt architecture was complete. Each crisis since 1971 had produced the same response. More debt, lower rates, larger central bank interventions. Each response solved the immediate problem. Each created the conditions for a larger future crisis requiring a larger future response. The IMF Global Debt Database documents the complete arc. 50 years of compounding produced a number beyond intuitive comprehension. $315 trillion represents roughly $40,000 for every human being on Earth. It represents 330% of annual global economic output. It represents a claim on future production that future workers did not agree to and may not be able to honor. The historical record suggests debt accumulation cycles end in one of three ways. Inflationary default erases obligations through currency destruction. Negotiated restructuring imposes losses on creditors through explicit write-downs. Prolonged stagnation suppresses growth while slowly eroding debt ratios over decades. The current cycle faces constraints that limit all three paths. Constraint 1, interest rate. Normalization. Inflation returned in 2021. Consumer prices in the United States rose 7% in 2021 and 6.5% in 2022. The Federal Reserve responded by raising rates from 0 to 5.25% by July 2023. Other central banks followed. Higher rates imposed costs throughout the debt architecture. The United States federal government paid $659 billion in interest during fiscal year 2023. Projections from the Congressional Budget Office show interest costs exceeding $1 trillion annually by 2026. Interest now consumes more federal revenue than defense spending. The mathematics deteriorate with each passing year as old debt matures and refinances at higher rates. Corporate borrowers face identical pressure. The IMF 2024 Global Financial Stability Report documents that $5.8 trillion in corporate debt requires refinancing by 2026. Companies that borrowed at 3% will refinance at 6% or higher. Debt service costs will double, profits will fall, bankruptcies will rise. Developing nations face the most severe pressure. World Bank international debt statistics show developing country external debt at $9.3 trillion. Dollar-denominated debt service requires earning dollars through exports. Rising rates and a strong dollar create simultaneous pressures. 46 low-income countries now spend more on debt service than on health and education combined. The rate normalization replicates the structure of the Volcker shock. Borrowers who assumed permanently low rates face a new regime. The mathematics that worked at 0% fail at 5%. Constraint 2, demographic inversion. Every previous debt cycle resolved partly through economic growth. Larger populations produced more goods. More goods generated more tax revenue. Revenue serviced accumulated debts. Growth eroded debt ratios over time. This path is closing. United Nations Population Division projections show working-age populations declining in 61 countries by 2050. China's working-age population peaked in 2015 and will fall by 200 million by 2050. Japan's population has declined for 15 consecutive years. Germany, Italy, Spain, and South Korea face similar trajectories. Russia loses roughly 500,000 working-age citizens annually. The demographic shift inverts the historical relationship between debt and growth. Fewer workers will support more retirees. Tax bases will shrink while pension and healthcare obligations expand. The growth denominator in debt to GDP ratios will stagnate or fall while the debt numerator continues rising. No major debt accumulation in history has faced demographic headwinds at this scale. The Roman Empire maintained population growth until its final centuries. The European powers that accumulated debts in the 18th and 19th centuries expanded populations through industrialization. The United States funded its World War II debt through the baby boom. Today's debtors face the opposite trajectory. The historical resolution path of growing out of debt is mathematically closing for most major economies. Constraint. 3. Geopolitical fragmentation. The debt architecture built since 1971 rested on dollar hegemony and institutional coordination. The dollar served as the global reserve currency. Central banks held dollar reserves. Commodities priced in dollars. International debts denominated in dollars. The system allowed the United States to borrow at preferential rates and run persistent deficits without currency collapse. The coordination mechanism operated through the G7 and later G20. Major economies met regularly to manage crises. The 1985 Plaza Accord coordinated dollar depreciation. The 1998 response to the Asian financial crisis coordinated IMF interventions. The 2008 response coordinated central bank liquidity provision. The system worked because major powers agreed on basic rules. Both pillars face erosion. The Atlantic Council Dollar Dominance Monitor tracks de-dollarization efforts. China and Russia conduct bilateral trade in yuan and rubles. Brazil and Argentina discuss common currency arrangements. BRICS nations explore alternative payment systems. Saudi Arabia considers oil sales in currencies other than dollars. The Atlantic Council data shows dollar share of global reserves falling from 72% in 2000 to 58% in 2023. The trend continues. Each percentage point reduction weakens American ability to borrow without consequence. Geopolitical coordination has fractured simultaneously. The G20 struggles to produce joint statements. Russia's exclusion from the G8 ended one coordination forum. U.S.-China rivalry prevents cooperation on economic policy. The institutional framework that managed previous debt crises no longer functions as designed. A debt crisis in the current environment would lack the coordinated response mechanisms that contained previous crises. Multiple currency blocks might emerge. Creditor-debtor negotiations might proceed bilaterally rather than through IMF frameworks. The architecture of crisis resolution has weakened as the magnitude of potential crisis has grown. What history suggests? Historical evidence from comparable debt accumulations offers 3 reference cases. Weimar Germany from 1921 to 1923 demonstrates inflationary default. The German government printed marks to pay reparations and domestic obligations. Hyperinflation destroyed the currency. Debt evaporated in real terms. Savings evaporated alongside it. The social consequences included political radicalization and institutional collapse. The Brady Bond restructuring from 1989 to 1994 demonstrates negotiated resolution. Creditors accepted losses of 30 to 50% on Latin American debts. Debtor nations accepted structural reforms. The process required years of negotiation and active coordination by the United States Treasury. A new debtor-creditor equilibrium emerged at lower debt levels. Japan, from 1991 to the present, demonstrates prolonged stagnation. The asset bubble collapse left Japanese banks with non-performing loans. The government responded with fiscal stimulus funded by debt. Government debt rose from 60% of GDP in 1991 to 260% by 2023. Growth averaged below 1% annually. The economy survived but never recovered its previous dynamism. The current trajectory suggests elements of all 3 outcomes appearing simultaneously across different regions. Some developing nations will default and restructure debts through IMF programs, replicating the Brady Bond model. Some nations will inflate away obligations through currency depreciation, replicating elements of the Weimar experience at lower intensity. Developed economies with reserve currency status will likely follow the Japan path, sustaining high debt levels through financial repression and stagnation. The historical term for this condition is financial repression. Governments hold interest rates below inflation rates, effectively taxing savers to service government debts. Carmen Reinhardt and Emmett Belen-Sprancia documented this phenomenon in IMF research. Financial repression allowed post-World War II governments to reduce debt ratios from 100% of GDP to 30% without explicit default. The process required 25 years, and a captive domestic investor base prevented from moving capital abroad. Whether similar repression succeeds today remains uncertain. Capital moves across borders instantaneously. Investors have cryptocurrency alternatives outside government control. The captive audience of the 1950s no longer exists. The evidence points toward a period of profound monetary instability. The $315 trillion accumulated over 53 years represents promises that the underlying economies may be unable to honor. History offers 3 resolution templates. Geography and politics will determine which regions experience which outcomes. Your position within this system depends on your assets, your debts, your location, and your age. Older citizens in developed nations with government pensions face exposure to financial repression. Younger citizens face lifelong taxation to service debts accumulated before their birth. Citizens of developing nations face the harshest adjustments as dollar-denominated debts become unpayable. The architecture of global debt was built by 5 decisions over 53 years. You live inside the building. The foundation documents from Camp David, the Federal Reserve Archives, the IMF databases, and the BIS quarterly reports tell you exactly how the structure was assembled. The documents do not tell you when the structure fails. They tell you the engineers knew the risks, chose to proceed, and left the consequences for those who came after. You or those who came after. The $315 trillion is your inheritance.